In this video, traders, we're going to look at the 10 pip scalping strategy for currency traders. Stay tuned. Hey traders, a very warm welcome to you. So this is one for scalpers, not one for swing traders. This is a scalping strategy that you can try out and see if it fits with the market you're trading, see if it fits with your styles, your personality, see if you like it, and see if you can adjust it and tweak it into something that works well for you. Okay, so this is, like I say, it's for scalping. It's on a 1 minute chart. It's for currency pairs only. I'd recommend this on something like US dollar yen, GBP USD, maybe not so much Euro USD, but you can try it out depending on the volatility at the time. Depends if there's a lot of news flow coming in. This is probably going to work well. If it's too quiet, this isn't the best thing because you're going to struggle to get the 10 pips. The whole point of this strategy is we're looking for a 10 pip finite target. So if the market conditions are that, hey, the 1 minute isn't even moving a couple of pips, this is probably not going to work for you, and you'll see in a minute why it won't work for you. So it's something that's reasonably active. So pick the most active currency pair. Obviously, we're going to manage the risk. I'm talking about stops of that in a second, but something that's reasonably active. You don't want to be trading the overnight session. So in other words, you don't want to be trading pound, US dollar in the middle of the night UK time. You don't want to be trading any US dollar cross in the middle of the night US time, yen in the middle of the night. You get the point. The idea is we're looking for something. I could trade US dollar yen during the US session because you've got the US influence there. But the point is you don't want to trade a currency pair when both of those sides of the pair are asleep. You get the point. Right. So 1 minute chart. And those are the things we can trade it in. The idea of this is we're looking to trade these extreme oscillations on a very, very short-term basis. Now, the key to any scalping strategy is to be brutally, I cannot emphasize this enough, guys, brutally disciplined with your exit. If you allow even one to go against you, you undo all the good work, because the point of a scalp is that you don't have a risk reward generally in your favor. You can engineer it to be that, but the scalp is that it's a high probability trade. It's quick in, quick out. Don't forget the spread plays a key part. So you're already kind of against the grain with it. But the idea is the frequency, if you've got a slim edge and it's just working out just enough to overcome the spread, to overcome all those other costs, grind out over time. At the end of the day, there's a profitable chunk there. That's the theory of it. Let's have a look at the rules. Okay, so the rules are this. First of all, we've got a 1 minute chart, as I say, and we have here an RSI, but it's set on 2. Distinct difference here, it's set on 2. Most of the time it's set on 14. Here we're going for 2. That's going to make it very, very noisy, but how we dampen out that noise is we put the extremes, the overbought condition at 90 as opposed to 70 normally, or 75 depending on the platform, and 10. So change that on your platform. Change the RSI to 2, change the extreme overbought to 90, change the extreme oversold to 10. That'll give you less signals. Even though it's a more aggressive, more noisy oscillator, it'll give you less signals because you're making it more extreme. So what we're looking to do is, the filter is this. When the price gets above, or when the RSI gets above 90, we're looking for short trades. When it gets below 90, or below 10, sorry, we're looking for long trades. So when it's oversold, we're looking for long. When it's overbought, we're looking for short. Okay, that's only a filter. Once it goes into that territory, we're ready on the button to go short. So price has gone up here. Let's say in this example, price has gone up into 90. It's pushed up. As it starts to roll and RSI starts to roll, by the way, you want to make sure that your indicator is auto updating here, because you don't want to wait for the close of the bar, because that's probably going to be too late. Yes, you're going to get whipped about a bit, but the point is you want to get in early while that momentum is pushing up and it's just winding. You want to be there hitting that trigger. So there's your short. You're not going to be far off that high there. And the idea is you're taking profits at 10 pips. Target 10 pips. Your short, sorry, the short is when it crosses, the cross, what I mean here, is when it crosses below that line that you've put in, that 90 line. Don't take it while it's extreme, because this could go extreme, extreme, extreme. You're waiting to see some evidence that the balance is tipping. As soon as you see that evidence and that comes back below 90, bang, you're hitting it short, ready there. You've got a 10 pips target, you've got a 10 pip stop loss, okay? Or if you don't get your 10 pips, if you're in a market that's not quite giving you the 10, I want to be very careful about going in that kind of thing. But if you are, you're not quite getting the 10, you definitely want to come out when you go into an oversold condition, because you're getting a reverse signal. So 10 pips profit, 10 ticks target, 10 ticks stop, or you're looking for a break of the prior high as a stop loss. And you can play around with this depending on the market conditions you're trading, all that kind of stuff. So you're either going to take it here, 10 pips, it might be here, but if you break the high before you take the 10 pips, you're coming out. Because the whole idea of this, guys, the theory of this is we don't overstay our welcome. But what we want to do is we want to see that the price is stretched in one direction, very, very short term, indicated by the RSI overbought condition, indicated by the RSI oversold condition, starts to then roll a bit. We're hitting it. If we're wrong, we're out. And that might be only a few ticks, a few pips, sorry, because of the nature of it. If it is, then we're coming out on that. We're not waiting for the full 10. So sometimes we're going to get good risk reward. If it happens to be the full 10, that's fine. We don't take it more than 10. That's the point. As it rolls over, we're looking to grab that little unwinding. It might still be the trend. And by the way, this could be an uptrend and we're still taking both. You might want to line yourself only with the long if you're in an uptrend. There's a little additions we can do to it. But the point is you're grabbing that quick snatch and it's turning over 10 pips, 10 pips, 10 pips, 10 pips. Vice versa, guys, we're going long when the RSI is less than 10. So RSI is less than 10. Let's look at another example here. Comes down to less than 10, starts to cross back up over. Don't forget, that's the trigger, that's the alert, that's the filter, should I say. The trigger is the cross back up above, 10 pip target, bang, take 10 pips off. Your stop is 10 pips below or below the last low, whichever is the least. You want to risk low amount on this, and because of the nature of the trade and the idea, you don't want to overstay your welcome. You're looking for that turn. If it doesn't happen instantly, get out of the thing, get out of the thing. Take a couple of pip loss, couple of pip loss, couple of loss. Okay, you're gonna have some spread on that, but that's what you want. You want to catch that turn. And again, if we want to try and adjust things, we can maybe adjust it and say, hey, price has got to be above our 50 period moving average on the day, 20 period, whatever it may be, and align ourselves just with that. But let's not try and be too clever, because very often we're going to get stretch markets that ping back and ping back. The whole point of this is, or the main filter that we want on this is that we have an average true range that's high enough. You know, you want a decent enough range, decent enough volume to be able to take 10 pips. If not, what you can do is you either ignore it completely and come back when it's a bit more busy and find a better currency pair, or you reduce that to kind of like 8 or 7. But be aware that when you do that, your spread is still going to be the same. You're still paying the same spread. And I know that spreads are tight on some of these currency pairs, but it's still meaningful when you're trading 10, 20, 30, 40, 50 round turns a day. So scalping strategy, 10 pips, major currency pairs when they're busy, stochastics, RSI, flick it to 2, change your extreme overbought to 90, change your extreme oversold to 10. Those are the rules. Good to go. Let me know how you get on. All right, guys, take care. Bye-bye.